Good morning, starshine.
Mortgage your house and buy Bitcoin with breathe air. There's no second best, okay?
GM, breathe air. Wednesday. It is the 4th of September, and I'm going to do a different trade of the day. I'm going to do a little lesson about open interest and what you see here and what it means. Okay. So, what you would normally expect to see when when the market dumps, is you'd expect to see open interest decline. Right? But that's not what you see here. So I asked, how do you explain this? Open interest rising as price falls rapidly, followed by price rising with OI declining. So if I find that part on the chart here, and go back and look at it. Does it go back far enough? It does. Here we are. Right? So typically this is what you expect to see. Market up, open interest up. Market dumps, open interest down. That's much more typical. Over here, market goes down, open interest goes down. Okay, cool. Why? Because typically when the market goes down, contracts are closing as people get stopped out. And usually, because crypto is quite long biased on the retail side, when it goes down suddenly, retail get wrecked. When retail get wrecked, that's when smart money should close their shorts. So if retail are getting wrecked on their longs, smart money are closing their shorts because they see retail getting wrecked, open interest declines. Open interest, remember, goes up only when a new long and a new short open. They have to have both. And it goes down when when a long and a short close. Only when both do. If a long opens and a short closes, open interest stays flat. If a long and a short both close, you see it go down. If a long and a short both open, you see it go up. All right, cool. So why would open interest rise literally exactly as it's going down? So this means positions. So first of all, it's very simple. Positions are opening. That's the fact. So you have the fact, and then you have some things that you can infer from that, right? So the fact is open interest rising means positions are opening. Now, many of you, and I won't get a chance to go through every single one. If I have time on the stream later, I will. We'll talk about more of them, but double divergence, plus plus and plus equals minus and minus minus equals plus, says Nick. So I don't understand that. Plus plus equals minus. I'm assuming he means price up, open interest up equals negative. I don't know, Nick. I'm sorry. I'm sure it makes sense in your head. Double divergence, though. Double divergence would be price falling and open interest rising would be a divergence, yes. And then I guess he means on the other way. Price rising and OI falling. Okay, so I've kind of deciphered what you meant, Nick. Price falls, open interest rises. You consider that divergence? Yes, you can. Price rising, open interest falling, you can call that divergence? Yes, you can. The reason why price falling and open interest rising is a divergence is because in a normal downwards market, you expect open interest to decline, like I said. Markets in divergence. Pattern suggests a classic short squeeze. Price initially drops, traders start opening shorts, which cause open interest to rise. Partially correct. Price falling, open interest rising. It does mean shorts are entering, but it also means longs are entering. So how would you know that the squeeze was going to happen? Or not even say how would you know. How would you position yourself to trade that? But that's definitely part of it. Short squeeze and people taking profits. Many traders enter in short positions, targeting a specific position to force liquidation. That is true to an extent, yes. There are definitely examples of larger players using the perpetual market to force the market lower, or to try and force the market lower. So they'll open positions, but they're actually forcing it to try and get it to an area like this, where there's a low that can be tagged, so they can fill long positions, or so they can stop out other positions. That one's the more difficult side. meaning you're trying to say, okay, well, lots of traders are getting short, trying to force the market lower, because you can brute force the market on derivatives in the short term, trying to force the market lower so you can get a better fill. Yes, that's partially correct. By the way, none of this stuff is wrong, because of course no one's going to come and, like, the market maker's not going to text me and say, oh, here's exactly what we were doing. The market is not run by one person, especially Bitcoin. So you're trying to infer what are market makers doing. By the way, market makers are not manipulating the market, right? Their job is to do the complete opposite. Their job is to provide liquidity. What people say when they say market makers is usually cope for their own bad decisions. And occasionally you have someone like Alameda Research, which is tied to FTX, who are market makers that were manipulating. Yes, but we see that happen to them. But in general, market makers are just providing liquidity. You're looking more at a large number of players. You've got high frequency trading firms, which can also be market makers. Generally, the two go hand in hand. You've got banks, institutions, governments, Michael Saylor types, rich people, regular traders, retail traders, prop firms, dumb money, complete apes, 125x leverage moon boys. You've got all of these people all doing it. It's never just one person. High leverage shorts got wiped. Rising could be shorts opening, short squeeze, people trying to long the dip. Jada win, yes. That's another important thing to remember. As it falls, open interest is rising. People are longing this too. The question is who's on the right side and who's on the wrong side. Shorts pile in, get squeezed out. Shorts entering. A lot of liquidations at the way down. Reality 1, GM. Move down is likely driven by some form of catalyst, data release, for example. The move down, correctly, was led by the New York session, to be exact. So this happened during, what was the 30th? I don't even fucking know, man. The 30th was Friday, yeah. Friday's New York session. And we also had core PCE. So the inflation data, core PCE, came out over here. And then we had the New York session. So yes, there was plenty of energy built up from that data release and then the New York session beginning. So that was the fuel for it. So, first thing, an observation and then a few different theories as to how this can happen. One, I've noticed that, especially in the last few weeks, if the New York session starts to have a downwards trend, people jump in very fast. This also happened yesterday. I think we had New York session here, right? And as the New York session began, what happened? Another sell-off. It's becoming a meme at this point that the burgers keep selling. And we go into New York session, selling begins. What happens? Positions build. Massive build-up of positions as everyone piles into the same trade. So, well, not the same trade, two trades. Bunch of people pile in short, but also a bunch of people pile in long. What happened? Well, this time, the longs were wrong. Wipe them out. Then you see three different types of participants. So you could see shorts. If we go back over here, where was it? It is this one, right? Yeah. So what many of you said, which is correct, it could be shorts. Now, like I said, when open interest rises, it means you have longs and short. OI up equals longs and shorts. But on every trade, you tend to have a market maker and market maker and a directional trader. So when you go long, it's usually not like me going short on the other side. In general, if people are directionally betting, whether it's retail or it's trading firms or institutions or whatever, typically if you've got one side that are unhedged, meaning when you go long, you just go long, you put a stop loss in, right? You don't go long here and short somewhere else. That's what market makers or delta neutral players will do. So usually if you look at a single trade, when you're long, it's usually a market maker or someone delta neutral who's on the other side of that trade. If you go short, it's usually a market maker or someone delta neutral on the other side of that trade. That's why when you see open interest rising, and I say it's both longs and shorts, you might think, well, how the fuck do we figure out where it's going to go? You have to then try and think about who's wrong directionally. on every trade, if you assume there's one person who's actually betting on the market to go a certain way, and there's another person who's not because they're hedged elsewhere, if you can figure out who's on the directional side, that's usually the side that will get punished. Because the people who are hedged, like market makers, they can't be punished. They might be going long here as you're going short, but they're hedged elsewhere. So if it goes down further, they don't lose money. You do if it goes up, right? So if it goes against you as a directional trader, you lose. If it goes against a market maker directionally, they don't lose unless it's a very extreme move. So shorts, opening. Longs, buying the dip. And market makers, which kind of goes along with it. Right? So this is what is happening. You can guarantee. There are shorts opening, yes. Always. There are longs, buying the dip, yes. And then within that you have market makers who are providing liquidity. So they have to, it's literally their job to take on the other side. So if you want to open a short and nobody wants to buy, because why would anyone want to buy when this is dumping? The market maker has to buy. So when you have the shorts, it's basically people speculating that it's going to go lower. This happens a lot now during the New York session because we've got this trend recently where Americans come in New York session during the week and they start to sell. So people try and jump on board and they try and ride that trend. And after it drops to a certain point, after the smart money, let's call it directionally, the directionally smart money gets short over here, right? By the time it gets down to here, it's dumb money. So people who are smart and get short up here will notice after the move that other people are still getting short here as open interest keeps rising. So that will incentivize those people from the top to start taking profit. Taking profit on a short is buying, and that's where you see profit taking. So when you see a move down and a move up, there are people in profit from here, and it's their taking profit. They take profit here, and they take profit here, and they take profit here. So them taking profit creates the buying pressure, combined with the dumb people who short here getting stopped out. So you have a one-way directional move. The smart money realize, okay, that moved pretty far, pretty fast, should take some profit. The dumb people don't know that, and they get squeezed. So you have a combination of buying here, which is smart money taking profit and dumb money getting stopped out. That's why when you see the bounce and it's the open interest declining, it's exactly that. It's the idiot who shorts the bottom getting stopped out. What does that mean? His contract closes. And it's the smart guy who shorted here taking profit, which means his short closes. So you have a lot of this buying pressure, which is closing of contracts, then going into the other side closing. So there has to be sell orders as well. So that would be longs who long the bottom taking profit, or longs who were long here and they were wrong, closing out, cutting their losses. It could be longs buying the dip as it goes down, right? This is, again, it's the same thing but in reverse. So when people see a sharp dip, they will add to it. They will buy. Add to their longs or open new longs. And that's usually because people think, okay, this dip has gone too far. So if you're longing here, you're wrong. But if you're longing here, you're right. So it's the inverse. Whereas the smart people would sell here and buy back here, and the dumb money would be buying here and selling here, you then see the opposite. You see the dumb money selling here while the smart money start to buy. So some people open positions here on the long side and then they close on the bounce. So like I said, let's take those two people. Smart sells here, which I'll put in green. Dumb sells here, which I'll put in red. Okay? These are positions opening. These are new positions. At the same exact time, on the way down, dumb are buying here, right? Because the open interest is rising, so dumb are buying there. And at the bottom, smart are buying. So again, you see this basically just the inverse of each other. So all the way down, you've got positions opening. You've got new shorts, you've got new longs, positions opening. You've got more new shorts and more new longs, positions opening. That's why open interest rises. So you've got a whole bunch of people all betting at different stages along here. Some are betting short, some are betting long, but they're all opening positions. When the market then starts to reverse, the reason you see it come down is the shorts who are wrong get stopped out, right? So on this part here, the shorts who were wrong at the bottom, these red guys, they're getting stopped out. The longs who were right will take profit. So these shorts getting wrecked are met with these longs taking profit. That's why open interest declines. Short stopped out, long taking profit, OI drops. On the way down, this short who opened and this long who opened are both also forced, or either forced to close, so the long, right, the guy who went long and held it gets stopped out or decides to close on the bounce. If he doesn't get stopped on the bottom, he closes on the bounce. And the smart short who opened near the top starts to take profit. So what you see after this directional move is you see the dumb money basically getting sacrificed for the smart money. Now, it doesn't mean that every single time you see the market go down with open interest going up that you see a bounce, but you do tend to. Obviously, yesterday we saw not that, right? We saw a big increase in open interest, and we saw the market unable to have this rally, but we did see open interest decline. So what you're looking at here, why did this one not bounce as far? Why did this one not go up like the other one did? Well, you can see the absorption. This is where passive spot sellers, which you don't see on open interest, must have been stepping in to stop the market. And you can tell this by the attempts, 1 push, 2 push, 3 pushes, so it tries to go higher, then it breaks structure, and you're noticing open interest declining all the way here. So the exact same thing happened, it just comes out with a different outcome, where shorts are coming in, longs are coming in, everyone's getting in, positions are building. Then it tries to rally and squeeze. The open interest is declining, which means what? The longs are closing, the shorts are closing. It's just not bouncing as far as you think. When you see a big build-up and a shallow bounce, and especially another structure break, that's a good sign that the market actually is directionally correct and it is moving in that area, and there we see it there. The last part, you can look at this and say quite reasonably, you can say, oh, well, also people were getting stopped out. But the magnitude of this is really something you have to calculate, as I showed. If you're looking here just at the white bars, which is long liquidations, from the moment we started to go down over here, you've got 10 plus 6 plus 1 plus 9 plus 29, 26. So if you calculate all of this here, as you see me moving along, it comes into like 86 or something, which I said that somewhere along here. 87 Bitcoin of longs on the way down, right? But that's 87. But there was a 5,000 BTC increase in open interest. So the amount of contracts opening was way exceeding to, fucking almost 70, 80 times as many than what was getting liquidated. So the liquidations were not the fuel for this open interest rise. So even though you see longs getting liquidated, many people would look at that and mistakenly think, oh, it's going to bounce like right away because all these longs are getting liquidated. Not necessarily the case. The thing that actually gives you your confirmation that you should be looking to go the other way is what? This. Comes down, fails to go lower, holds, starts to break structure. That's when we're going to start rising. Right? So you always have a combination of longs and shorts, and then you have to think about who's the market maker, who's the delta neutral side versus who's the directional side, and most importantly, watch the bounce. How far does it squeeze? You'll notice in both of these examples, the previous trend continues. Even though there's a squeeze here, it comes up, it reaches a resistance, and it goes to new lows. Here, same thing, open interest rises, we see a squeeze, it doesn't bounce as far, but it's the same outcome. We go lower. That's always something that you want to be aware of, right? The directional move tends to follow the previous impulse until we see something like say this one. What would invalidate that? It would be like this. It would be a reclaim, right? Price comes up and comes above it. When it gets back above that point, you say, oh, okay, now we're doing something different. So that's it, little breakdown, little mini lesson, GM.